Good morning, folks. We'll wait just a couple of minutes to get started here. Okay, we'll get going. Good morning, everyone. My name is Josh Stripmatter, and I would like to welcome you to our Stripmatter Wealth Smart Money webinar series. Thank you for joining us today. Our presentation today is titled April 2022 Student of the Market. For those of you that don't know us, we are Stripmatter Wealth Management Group, a registered investment advisor located in downtown Fort Worth, Texas. We specialize in investment management, financial planning, estate planning, and real estate investing. We have been in business since 2007 and serve clients throughout the United States. A little bit of housekeeping before we get started. All of you have access to the chat feature, so if you have any questions, please don't hesitate to type those in. We'll be happy to answer those questions for you. Also, we'll be sending you out a replay of today's webinar via email, so if you miss something, don't panic. You'll have the ability to watch this again. And you are welcome to forward these presentations and any of these presentations to your friends and family if you think it would be beneficial. Today's webinar is meant to be purely educational and not meant as tax or legal advice. Please talk to your licensed professional before taking action on any of the information in this presentation. For more information, including key disclosures, please visit our website at stripmatterwealth.com. Now, let me introduce our speaker today, Mark Peterson. Mark is the Director of Investment Strategy and Education for BlackRock, where his responsibilities include relating BlackRock's investment strategy and investment views to key institutional and financial advisor clients, and offering perspective on all asset classes, including equities, fixed income, alternative, and multi-sector approaches to investing. Mark is a 20-year industry veteran with extensive expertise and experience educating financial professionals and investors on market and investment topics. Mark has received his bachelor's degree from Arizona State University. So without further ado, let me hand it off to Mark. Good morning, Mark. How are you?
Great. Thanks, Josh. Good afternoon, everybody. Thanks for having me on your call today. Talk a little bit about what's going on in the markets. Not a shortage of content, right? A lot of different concerns here in 2022. Feel like we have all the boxes checked, actually, from a concern standpoint, right? You think about Russia, Ukraine, you think about inflation, right? Certainly grabbing headlines, market volatility, bonds off to a really sluggish start this year. You go down the list, you had a negative GDP number this morning, and COVID's still hanging around, certainly globally. So I feel like we have all the boxes checked. We'll try to hit some of those. We probably won't be able to hit all of those. That might take us an hour or two, but we'll give you our thoughts on the market, where we stand, where we're headed for the rest of the year and into 2023. And as always, I'm kind of a chart and graph guy, so bear with me. I'm not short on charts and graphs today. But we'll try to give those some color so they come to life a little bit more than just being hardcore numbers and lines and graphs here. So let's jump right into the first story. I think Russia, Ukraine, right, is grabbing headlines consistently here. You've probably seen a chart similar to this, just looking at stock market performance when we've had other geopolitical challenges over the years. So kind of break out the history book. How did the market do a little bit before, a little bit after, and then 1 and 3 years after? And you can see the amazing resiliency of the stock market. So a lot of numbers here, but look at that far right column, 3 years after some of these really big history changing geopolitical events. You can see where the market was 3 years later, right? And that's an average return per year for 3 years. You can see only one period, that Germany invading Poland in 1939, was actually lower 3 years later. And of course, that was because we were still in the middle of the World War II in 1942, right? 3 years after 39 was 42. And the war's outcome was still undetermined at that point. You can see even after Pearl Harbor 3 years later, how much the market had rallied, into 1944. At that point. But I think just really the history shines through here. that the market tends to be amazingly resilient in the face of some of these big challenges geopolitically. And I can tell you, if we were to update the 1 month later number following the Russia invading Ukraine, if I had this one updated, it would be actually up 5.5%. The market's actually up since Russia invaded Ukraine 1 month later. So I thought that was interesting. And just to think about stocks a little bit more, it is off to a slow start this year. We're down a little bit over 10% for stocks. And this was through the end of February, but I thought it was interesting just to look at other years in which we started out slowly for stocks. And you can see that this year was actually fifth worst start to a calendar year through the first couple months. But interesting, I think the most important point here is look what happened the next 10 months. And most of these periods of stocks actually ended up significantly higher for the rest of the year, except for two of the entries. 2008, if we look at 2008 there, and if we look at 2000. And those periods are interesting because they were surrounded by or incurred a recession during those calendar years. So you had 2008, of course, was a global financial crisis, right? That was in the middle of that housing bubble, and companies were not surviving, right? Some of that financial turmoil in 2008. And then, of course, 2000 was the tech bubble bursting, and we had a recession in 2001. So both of those periods where stocks got off to a slow start and finished the year negative were surrounded by a recession. And I think that's really the key factor this year, right? That folks are going to keep an eye on is, are we headed for that recession? And certainly the negative GDP number today certainly wasn't great news, but probably might be a little bit overstated to the downside. But I think that'll be something to keep an eye on for the rest of the year. Certainly at BlackRock here, we don't think there will be a recession. We think the economy is still on pretty solid footing here. Still a little bit of a coiled spring because we haven't spent money and traveled and done things like we normally would the last couple of years. So consumers are in great shape. And I think that'll really start to shine through for the rest of the year. It might be a little bit bumpy to get there, but I think it'll help absorb some of those challenges that we talked about, like higher interest rates, like the turmoil with Russia and Ukraine, like higher inflation as well. So it's going to be a little bit bumpy, certainly painful, but I think we don't see a recession in 2022 or even the first part of 2023, which history tells us bodes pretty well for stocks going forward. And one thing when we see periods like this, when market volatility, right, when the market's getting fairly sizable movements up and down on a specific day, I think it's always good to remind ourselves that some of these best and worst days in the market sit right on top of each other, right? The good and the bad days are almost right on, they live in the same neighborhood, really right on top of each other. And such a, 2020 in March was a painful, but a great example of this reality. That when you get periods of high volatility where the market's swinging, and it's like a pendulum, right? It'll swing one way dramatically one day, and then it might swing back the very next day to a similar amount, but the opposite direction. And you can see that March of 2020 was a great example, right? This is when the pandemic and the shutdowns were really taking effect. The market was trying to figure out what that would mean. You had you had 3 of the worst 15 days in stock market history in March of 2020, right? 3 of the worst 15 since 1950. So 70 years of history. And you had number 2 and 3, right? You can see March 16th, March 12th, you were down 12 and 9%. Only October of 1987 was worse. That was actually the worst day in history. If you remember that Monday, we were down over 20% in stocks. But interesting, right? We had 3 of the worst days, but we also had 5 of the best days in March and April of 2020. So 3 of the worst, but 5 of the best, including number 3 and 4. And a couple of these days were the very next day, right? So I think that's just a good reminder, right? What works in investing. This is the old time in the market, not trying to time the market story, right? That old market adage, but I think gives a little bit more detail why. Because if you move out following one of these worst days, right, which certainly is, I think, all comes to mind to all of us. But you need to understand that you don't want to miss some of these best days on the other side. That's just a critical story, because these best and worst days live right on top of each other. And you can see over the last 20 years, we actually expanded it out. And you can see that of the 25 worst days, 24 of those were surrounded by 25 of the best days, right? So no matter how you slice this is just a natural evolution of market volatility, right? Is that these best and worst days sit right on top of each other, and don't let that stir your emotions. Building that on that a little bit more, I mentioned all the bad news. I think it's easy to feel bad about things and how things are going. And that's what this chart looks at. It's just the satisfaction level of folks across the U.S. This is the old Gallup poll, which actually isn't too political, right? I've been doing it for a long time, and you can see the satisfaction level bounces around. And we came off of one of the lowest points ever back in January of 2021. That was when COVID was really heating up, and certainly February of 2022 here, we were still pretty darn low at 21%, which probably isn't a shock, right? It's gotten a little better since COVID's eased, but we're still pretty historically low from a satisfaction level. And certainly with inflation, Ukraine, other challenges, this number is probably going to continue to be low here for a while. But what's interesting is look what happens when you marry stock performance to those various levels of satisfaction over the years. It actually works the opposite of how you might think. So the lower the satisfaction with the economy, or with how things are going here in the US, the better it is for stock performance going forward. It's all the bad news is built in, right? Is the way you can think about it. So going forward, it actually could be a good thing for stocks, where stocks, whenever satisfaction levels have been below 33%, stocks have averaged 15% over the next 12 months, versus when folks are really satisfied, 50% or greater of the country is satisfied, stocks only average 6%. And you can see you had periods of time where in February 1999, 71% of the country was satisfied. So I think that's an interesting dynamic that I think is good to remind ourselves as well during periods like this, where we feel like all the bad news, there's so much bad news out there. Sometimes the market has to climb that wall of worry, is another market adage that used. And I think this really shows why that is, right? Sometimes the best time to put money to work in stocks is when things feel really bad. And certainly that's what history tells us. The last thing on stocks, and we've been talking about this for a while, is just all the cash on the sidelines. I think this is both good for the market and the economy. Is again, we haven't spent money like we normally would, right? Haven't gone out to eat, haven't traveled like we normally would. And there's a ton of money on the sidelines. Some of this is purely government stimulus as well, and certainly helped cause the inflation. But look at where money market assets are today. We're at 4.7 trillion at the end of the year. We're slightly down from that, but still right around 4.5 trillion in money market accounts, which are kind of those cash on the sideline accounts, still paying very little, even though short-term interest rates haven't come up. And look at what stock performance looks like following some of those other previous peaks when you get a lot of cash on the sideline accounts, right? Look at historically very distinctive peaks here, right? In January of 2009, that was the bottom of that global financial crisis, right? You had a very distinct peak where you had a ton of dollars go to that sideline, 3.8 trillion in assets. January of 2003, 2.3 trillion. In assets on the sideline. And you can see what stocks did 3 years, and this is actually 3 years after, right? So 3-year average annual returns were really, really good whenever you saw a lot of dollars go on the sidelines. Again, you can think about these dollars eventually find their way back into the market, tend to be very supportive of prices in the near term. So I think that's another positive that'll help the market here, is we've got a lot of cash on the sidelines, and it'll help the economy as well. Right, it helps the consumer spend. It helps other challenges that might be faced by a slowing economy or higher interest rates, is the fact that folks have a lot of dollars on the sidelines. So that's the stock story. Let's switch gears and talk bonds a little bit. And I mentioned earlier, worst start, actually, it's the worst start ever for bonds for a calendar year. So Josh and I were talking about it before the call. Certainly, I think it's going to be a surprise for folks, right? Is seeing their bonds down. We're just not used to it over the years, but it does happen. You can see this chart looks at 2-year windows. So just 2-year periods of time where bonds have lost money. This is the third worst 2-year window historically. And you can see the other two worst. The two worst were 1980, 1981. That was also a period of really high inflation, right? But you also had very high interest rates. And you had interest rates start to come up to try to match inflation back then. And you can see how well bonds did the next 2 years following that 80 and 81 period. But it's a little bit different today because interest rates are just starting from a much lower point. I think more illustrative of what we could expect is what you see in 1956 and 1959. I think those periods are interesting because we're starting from a similar interest rate level, right? Where interest rates are low, the economy is heating up a little bit more, inflation's more of a challenge. Certainly not as much today as it was, or excuse me, not as much back then as it is today. But you can see that you had some periods where bonds struggled, but those were followed by periods where bonds returned to more normalized level of returns, 3% and 6% back in the 50s. So the 50s is pretty comparable because we had a very low interest rate world coming out of World War II, coming out of the Great Depression. We had to pay for the wars, so they kept interest rates really low. Not too dissimilar what we've seen here the last handful of years. So some pain to get there, but we're in a better place for bonds than we were, say, a year or two ago. Think about at the end of 2020, interest rates were below 2%, or excuse me, below 1% on a 10-year treasury bond. Today, they're closer to 3%. So that's 3 times the income, almost 4 times the income today that you're receiving from a 10-year U.S. Treasury bond than you were getting a couple years ago. So that's a much better starting point for bonds. It was some tough medicine to get there, but I think it'll benefit portfolios going forward. But certainly will show poorly going forward, on statements and certainly portfolios here year to date. And here's a better picture, right? Just the longer term interest rate and bond return story. I think we could probably do a half hour on this slide alone. Always one of my favorites, although you can see I have a lot of favorite charts and graphs. But look at the 1940s, 1950s. The red line is interest rates, and the yellow bar is bond returns by decade. So wherever that interest rate starts, that's generally where bond returns will be 10 years later. And I think that's important to understand that reality, that we're just in a lower bond return environment going forward. It's not going to look like the 80s and 90s, right? It's probably going to look more similar to the 50s and 60s going forward. And certainly that'll be a challenge for portfolios. I know certainly Josh and team are working with us to do things to make sure we can get a little bit more income, get a little bit more return out of bonds, but also balance that risk that's so critical, right? So how do you balance that risk? That's really the challenge in today's world when you're looking for more income and more return, or at least try to get a little bit more out of this portion of the portfolio without giving up that safety and stability that really is why we own bonds in the first place. So I think this historical look is pretty important. And one thing to keep in mind here, and I think it really flows well into the inflation story, is that we have had interest rates come up clearly due to the fact the Federal Reserve is going to raise short-term interest rates. They've done it once already. They're going to do it again here, probably by 0.5% here at the upcoming meeting. But the market's pricing in a lot of Federal Reserve short-term interest rate increases this year, anywhere between 2.5% and 3% more, which we don't think it's going to be quite that aggressive. We think it'll be at a much more measured pace. A lot of uncertainties out there, such an unusual dynamic with the pandemic and the shutdowns. I think the Federal Reserve is going to take it a little bit slower, live with inflation for a little while, and not try to tip the economy in a recession. That's always the concern. If you raise short-term interest rates too fast and too much, that you might tip the economy in recession. So we think that they're going to be a little bit more patient, a little bit more measured than the market's anticipating. I think that'll be good for stocks and bonds here for the rest of the year if we're right. Of course, if we're wrong and short-term interest rates come up faster, that's going to be a big headwind for both stocks and bonds for the rest of the year into 2023. But we just don't think that'll be the case. And one of the reasons why we think that is, we think inflation actually might have peaked here recently. And certainly Josh knows I'm a little bit of an inflation geek. So it makes me a hit at all the cocktail parties again. I can dust off my inflation story. But we've had 8.5% inflation. That was the latest number. Think about 8.5% inflation in today's world. That's the largest inflation number we've had in 40 years. And you could actually argue that it's the largest inflation number ever, because of the way they've changed the inflation calculation over the years. For example, they don't have housing prices in the inflation calculation anymore. They took that out in 1983, and it's really smoothed out the inflation calculation over the years because rents are a lot more stable. I don't know if we have any landlords on the call, but it's hard to move rents up or down. And that's what they use. 40% of the inflation calculation is housing, yet there's not a housing price number in the inflation calculation. It's all rent. So that's a change that they've made that's really helped minimize some of the dramatic movements in inflation, both up and down, right, with the housing bubble. But you could argue today, and I've seen some estimates, that inflation using the 1980 calculation for inflation would be 15 to 17%, not 18.5%. There's that big of a gap between housing prices, which are up about 20%. I know folks in Texas, it's probably even greater than 20%. And rents, at least in the inflation calculation, are only up about 5%. So certainly that's a challenge. And rents are going to continue to be a challenge in that inflation index. Whenever you get housing prices up for a sustained period of time, that's a lot of leverage for landlords to raise rents. So rents are going to be a problem, but we're going to start to roll off some of those other oddball price increases that we've seen from the bottom of the pandemic. Really started in March or after March, and it'll go through July, where we start to lose some of these really oddball categories that saw enormous price increases, like used cars was a big ones, or car rentals as well, or hotel rooms. If you've stayed anywhere, you see that as well. Some of those actually start to wind down and actually start to show price decreases in the coming months. And I think that'll help the inflation number trail lower towards the end of the year. And I think that'll help the Federal Reserve be a little bit more patient, right? It'll look like it's working, that they're raising short-term interest rates, and interest rates have gone up and inflation is starting to come down. So I think that'll look like a win, even though it's more of a reality of just the way the calculation and the numbers roll with inflation. But I've tried to ring the bell on this. The big story I think the press misses is we've got 8.5% inflation, and interest rates and savings rates and cash rates are little to nothing, right? There's an enormous gap between 8.5% inflation and what you can get on conservative investments and savings and cash accounts, right? All that cash on the sidelines. They're losing out to inflation like they haven't lost in over 70 years, right? Think about that. That's an enormous challenge for folks. And I just think we need to ring the bell on that more. Certainly folks on this call, I'm sure, have a good plan in place with Josh and team. But if you have friends and family, help them out, right? Get them over to Josh, because don't underestimate this, right? Think about losing out to inflation, like this certainly can create a pretty big lasting hole in somebody's portfolio and wealth. This is my circus tent. I always say, if you stare at this one hard enough, it looks like a circus tent on inflation. You can see these are the 8 different categories of inflation, and just highlighting some of those categories that we touched on. Look at car and truck rental, right through the end of the year was up 36%. Lodging away from home as hotel rooms up 24%. But really, when you look at inflation, it's not one thing, it's not one reason, right? I think the news always wants to say, oh, it's because of energy prices, right? Or it's because of food, or it's because of supply chains, or because of war, Russia, Ukraine. There's no one reason. There's a lot of different factors here impacting inflation. So don't fall for that. It's really a perfect storm of a lot of things. We talked about the renting and housing dynamic, right? You can see housing 41% of the index, and it's up over 5% at this point in time. You can see food is a major challenge. Food prices are continuing going up. One of my favorites, bacon, is up over 19% the last 12 months. So you can see a lot of different challenges. There's not one reason for inflation. It's a lot of different reasons really putting stress on it. And it's bad when stationery and gift wrap are up 9% in that bottom right-hand corner. Inflation's bad. But I think the story gets a little bit better towards the year end. It won't be 8 or 7% inflation, maybe closer to 5 and 6. And lastly, we've touched on it a little bit here, just the importance of the diversified portfolio. We talked about what a challenging environment it is when inflation's a lot higher than traditional interest rates and savings rates. The only way to fix it is to have a good, sound financial plan. And that always includes a well-diversified, well-thought-out portfolio. And this is always one of our favorite slides that looks at that diversified portfolio. In this case, we're using a 60-40 stock and bond mix versus the S&P 500. And you can see emotionally why it can be so difficult, right? It just doesn't feel good sometimes to own that diversified portfolio, right? You still lose money in a bear market, right? Losing 26% in 2008 being a great example, right? That never feels good to lose a quarter of your assets in a calendar year. That was probably one of the worst calendar years ever, by the way, for a diversified portfolio. And then when the bull market returns and prices go up again, you don't make as much, right? You don't make as much and you leave a lot of money on the table. Look at that. No better example than the 2009 to 2019 period. This was the longest U.S. economic expansion in history, right? It wasn't the best or the fastest economic growth, but it was the longest from a time period standpoint. And look at how much the diversified portfolio trailed, right? You left 130% on the table by being diversified. That doesn't feel so good either. And certainly we had a lot of investors, even some of the best folks we work with across the country, wonder about their portfolio, if it made sense, if they were left too much on the table. And of course, we've had the same dynamic the last couple of years here, right? We were down in the first quarter of 2020 when the pandemic and the shutdown set in. Then the next year and 3 quarters, we were up big. Yet the diversified portfolio trailed in a big way, right? Only about half the returns of what the stock market saw. So this is a natural feeling, right? With that diversified portfolio, it just doesn't always feel good. But I think we need to remind ourselves why we build portfolios the way we do. If we add up this entire, and this is a little bit more than 20 years, the diversified portfolio actually beats the S&P, right? It beats the S&P, and it does so with less risk, less drawdown of your initial dollars invested, less volatility. So for us, just a great reminder why we build portfolios the way we do, why we asset allocate and diversify and spread your investment eggs across a variety of investment baskets. It's all to get to what we call at BlackRock, winning more by losing less, right? Winning more by losing less. You don't need all the upside of what the bull market brings if you do a better job in the downturn, right? That's how you build wealth over time. It's just tough to see because you go through these periods, and some of these periods like that 2009, 2019 can feel like it lasts forever. And it feels like you're losing in a big way forever, but it's just not the case when you start to connect the dots. Look at the bull and bear in combination. I think that's really why this chart works is you're looking at a full market cycle, right? The bull and bear together, not just the bull or not just the bear or not just some of the bull and bear. You're looking at a full market cycle, really brings out the benefits of diversification and what we do when we build portfolios. So always a good reminder, I think more important than ever, again, because of that higher inflation challenge, this is the only way to bridge that gap is to have a well thought out, well-diversified portfolio for today's time. So why don't I stop there, Josh? I think I'm out of charts, believe it or not, but hopefully this was helpful. Think about where we started, right? Certainly been an unusual period, lots of concerns. Both stocks and bonds are down to start the year, which certainly is painful, but it's going to hinge on that recession, right? If we don't get that recession, which we don't think that we will, certainly it'll be a positive for stocks. Bonds, certainly more of a challenge, especially given the fact the Federal Reserve's raising short-term interest rates. But if they don't raise short-term interest rates, maybe as fast or as much as the market expects at this point, which is what we think that'll be good news for both stocks and bonds going forward. It's just more of that inflation challenge, right? Even if inflation comes down like we think it will, it's still a big gap between inflation and traditional interest rates, savings rates, and cash rates. You need to put that money to work. This is the worst time in so many years, right, to have cash on the sidelines. And we saw how much there is. Having that well-diversified portfolio is your best defense against that. And don't underestimate, help your friends and family out if they're not aware of that. Because I think sometimes inflation can grab the headlines, but it's often tough to see the actual impact to your retirement savings, right? The government doesn't send you a statement showing you how much inflation's eroded your portfolio. So you got to be in tune to that. So Josh, let me stop there. I'll stop sharing, see if there's any questions, comments, thoughts out there.
All right. Well, thank you so much, Mark. And we will take some questions. Let me, first of all, bring up my slide here. Well, try that again. So we'll take some questions. And before we do that, though, let me thank everybody for joining us today. And if you have any questions after today's presentation, feel free to give us a call at 817-210-3444. You can also go to stripmatterwealth.com, and we've got some great information on there for you. You can sign up for our weekly market update e-newsletters that we send out that has some great information. And then, of course, we have the Ask the Experts radio show on Saturdays at 10 a.m. on 1190 a.m., where we answer your financial questions. So let me stop recording, and then we will answer any questions that you have.